So I'll give you two things. One, I think, is this commercial aerospace and military. There's a stock we own for clients called Do Common, ticker is DCO. It's about almost half and half military and commercial. They sell to Boeing and Airbus. Their biggest customer is Raytheon. They had a good earnings announcement, and the stock responded. And they've got some good long-term goals they're going to try to execute again. So I see a 2 to 3 year horizon. And so, there's, you can see the chart, and it's not kind of above a high. So, that's something, if somebody wanted to do some work in that area, or you could put up, show me the comps, and you'll get 5 other names to look at. And I may be involved in a few of those, and clearly I'm down cap. The other area I think people can look at are U.S. regional banks, and picking up a little bit on what Schuyler said. The banks are very healthy compared to the great financial crisis. I mean, they've tripled their capital levels. Thank you, Elizabeth Warren, right? They haven't chased crazy loans. I mean, the private BDCs and leverage credit funds have used the leverage, and the banks haven't. They are regulated. And tonight there was another story, and I haven't dug into it, but the Senate just voted to undo an OCC bank regulatory merger prevention that Biden put in. So maybe this deregulation can spur some bank deals. And bank deals generally over the last 6 years have been positive, because you're consolidating all of the assets off of one platform onto another. And there's a lot of cost takeout and a lot of synergies when you do that. And I think the capital levels at regional banks are pushing 11%. The yields can push as high as 5-6%. And they're still out of favor because people remember the financial crisis, or they remember Silicon Valley Bank, which was a hedge fund or a venture fund or whatever you call it, wasn't a bank that matched its assets and its liabilities. So I see a lot of neglect in that group as well. And there's stocks that aren't so small cap there, but 4, 5, 6, 7 billion is a good group in there that I'm talking about.
And last question for you is more of a broader topic, because you and I, when we spoke a couple of days ago, we were talking about the tariffs. The question that nobody can answer, but I'm going to ask you: how long should your clients, should investors, be patient with the tariff negotiations to figure out what the next part of this is going to look like?
So again, I think, look, the markets have told you we're back to pre-Liberation Day levels. And I think people think the reciprocal tariffs, and this is my view, I think they think they're not going to come back. They might keep this 10% level, and I think the market can digest that. I don't think you'll see a 10% price rise. Remember, it goes into COGS. There's cost cutting and moving stuff around. So you'll see some price increases, but maybe not the full impact of the 10. China's a wild card. Besant's going over there to start the conversations, and I think they have to move. Where that winds up is a risk. And if we don't get anything, that might be a downside catalyst to the market from here. And I think if we roll around, is it July 2nd and the reciprocals come back on? I think you can see risks. So there's risks, but when you look at 2 to 3 years, the risks aren't as bad, especially if you have a company with a good balance sheet, has the ability to grow, and at this point is undervalued and perhaps neglected or feared or just unrealized by other investors, meaning there's some good news to come or others can discover it. So I agree with what Schuyler's talking about on rates. I mean, stay short. And again, I have my clients pretty much under a year. You don't get paid to go out. And taking the conversation a little differently, and I won't stay there, Trump's concerned about the budget and the deficit. And I think that's where this tariff situation is coming from. He wants to grow GDP to raise, income. He's talking about raising taxes on the high over $1 million to cut the deficit. And Elon Musk is in Washington trying to cut his spending because of the deficit. So the long rates, I don't know. I wouldn't step up and buy a 10-year treasury here, when you can stay short, on a 6-month, 9-month. And I think Schuyler said you can get, some pretty, relatively safe. There is no safe, right? But I mean, relatively safe in some of the things you talk about, agencies or munis with equivalent yields and short durations. But for the cash that you don't need to keep in cash, it is stay opportunistic, look long term. This whole market is suffering from what I call short termism. And that's a 30-day, even single day options. That doesn't make any sense. It's just that's akin to gambling, and I can't put my clients' money there. But if I make time my ally, take a 2 to 3 investment horizon, have reasons to be there as far as a solid balance sheet, can grow revenues and earnings and ROIC, it is undervalued. That is how you can stack the odds in your favor over the long term. And when you start thinking long term, you can look at some of the damage that was done after Liberation Day and say, boy, that's kind of crazy that this stock has 95% domestic revenues and has said that tariffs won't be an impact, and it's still down 20%
Sure.
a year. So maybe I'll go there.
So picking up on the tariff situation, the potential for the supply chain disruption, we're already seeing that. But the average American, we're being told by the media that it's going to get worse in the next month to 2 months. Is that driving investment decisions at this point? Because I don't think any of us understand what that truly means, that it's going to, quote, get worse.
Well, so there was panic post Liberation Day, right? I mean, my clients were talking to me, what's going to happen? The media was telling us it was a Great Depression, tariffs started the Great Depression. And look, tariffs can go wrong. And if he pushes too hard, things can break. I think you saw the bond yield spike he talked about earlier. I think that was hedge funds. I don't think that was China and Japan dumping treasuries. I think it was hedge funds getting offsides or people covering their margin, which I don't think is really ever a good idea for an individual investor. But I think at this point, we have a 10% tariff on most of the world. Investments going over to China or going to talk with China now about de-escalating. I think you will see prices go up. And I think what I'm listening for when I look at companies is who learned from COVID, right? I mean, we had a situation where a supply chain shut down 5 years ago. And if you're a management team getting on the call and saying, oh no, it's like, talk about the great management teams are the ones that have gotten out of China and have gotten a home and have diversified into dual sourcing. Plenty of companies have that message now and are talking about mitigating tariffs and potentially gaining market share from those who can't. That's the beauty of being active. You're not stuck in an ETF mindset where it's good or it's bad from a high level.
So let me ask you this, and I'm glad you brought up the management. I'm going to interpret what you said as Tim Cook and team at Apple, shame on you. I was cursing them yesterday because I opened up the drawer and I have wires and chargers that don't work anymore because they're obsolete based on how they change the charging device repeatedly. But Apple, it's a two-part question, but when you talk about those companies that failed to anticipate what we're now seeing in the shift, Apple's going to produce iPhones in India. They would seem to be 5 years late then, if I'm hearing you correctly.
Not necessarily. And again, I don't own Apple, so I haven't been following it quickly, but I think I heard Apple say everything they're going to produce for the US is going to come from India. That I think is new in the last 5 years. And that's what I would call a good management outcome if that's what happened. Because we're close to an India deal. We might have zero tariffs with India. And if Apple supplies phones from India to the US, there is no tariff issue on Apple phones. Now, maybe pricing will get adjusted. Who knows how it all washes out. But that's what I'm talking about. And the companies that, stuck in China and never tried to move or kept one factory or didn't get their Canada or Mexico plant compliant with USMCA to the extent that they could, they should have. And now you'll see a scramble to do such.
And real quick, there was news today because of a trial involving Alphabet, but Apple apparently is considering using Perplexity and other AI agents as part of its search in Safari. And what we learned is that they are paying Google $20 billion a year, but that's going to start being diminished because people are no longer searching quite the way they used to. For the Mag 7, and I know you get upset with people who focus only on the Mag 7 because you do specialize in finding those undervalued stocks in small and mid cap. But that kind of news on an Apple, that would have ramifications because a lot of index funds are heavy to the Mag 7. So what did you have you heard about this? It broke around 3 o'clock this afternoon.
So again, and I don't own Apple, but I have heard, and this is not new news, that Apple's been paying Google, right? Or yeah, and there's been a revenue source there, and so that's in jeopardy. Theoretically, active investors should have known that we're in Apple, and I don't know how much of the news is fear and liquidity, and how much is really new on that one. But that's what I would dig into if I own the stock. To your point, the Mag 7 are about 30 to 32% of the S&P 500. So when you start talking about the market, and you kind of mean the S&P 500, which isn't the market, you're talking about the Mag 7. And for those that think they're diversifying by buying an ETF of the S&P 500, they're buying the Mag 7. I mean, those names dominate. And so you do become kind of an active investor when you buy the S&P 500, whether you like it or not. I think you kind of have to have a view on the Mag 7 if you own that ETF. And I think the whole point of owning an ETF is you don't have to have a view on the stock. So with the concentration and the weighting, I think it shows some of the problems that can happen with ETFs. And it's been a good index in the past, but maybe some of those valuations have to catch up with those stocks, in my view.
When you talk to your clients about mid to small cap investments, do they want to hear that? Because the world has been so focused, NVIDIA, Tesla.
I think I think people like fresh ideas, and I'm not saying you can't own the S&P 500 and you can't own any of the Mag 7. The stocks are good stocks, and trust me, I think AI will probably be a bigger game changer than the internet was. As far as when it was introduced in 2000. I mean, I've seen every business and every student I know incorporate it into their workflow in their life. What I'm saying is, if you don't confine yourself to a group of 7, there's plenty of places down cap that either are making chips or supplying power or building data centers or laying cable or any one of a number of things using AI for their businesses, either to balance their accounts or improve their efficiency or improve their supply chain. There'll be a lot of places where that efficiency can ripple through, and those opportunities, I think, are still on the come. So, that's just for AI, and then you have companies that can take advantage of supply chain disruptions, and you have companies that won't be impacted at all by the supply chain. So, you open your universe from an S&P 500 to when you go down cap. I think my universe is in excess of 5,500.
Were you always focused on, these undervalued small and mid cap stocks throughout your career, or is that why you launched Rewey?
I launched Rewey, yeah. So I launched Rewey in 2019. Nobody wanted value stocks. That's when the S&P was kind of ripping, and value was out of value. Value was out of favor. So now I've got 6 years in, and my results have been pretty good. And I think now, before this tariff situation, we started to see a rotation away from the S&P 500, and maybe it was rebalancing because people had made money. Maybe it was rebalancing down because people don't own this area. I mean, if you own the S&P 500, you don't own many small caps. And again, you have index like the Russell 2500 or the Russell 2000 or the Wilshire 5000. There's lots of other names out there. And if you stay in the S&P 500, you're limiting yourself to somewhat. Again, and that provides active research. These names are neglected. A lot of them don't have the sell side coverage. A lot of them don't have much sell side coverage. And I think if you do your own work, and follow a philosophy, you can stack the odds in your favor.